Have you ever wondered how to start investing in your early 20s? Imagine a snowball rolling down a hill. As it rolls, it picks up more snow and grows larger. This is the essence of compounding, and it's the key to growing wealth over time. When you begin to invest early, each dollar you invest has more time to generate earnings. These earnings then get reinvested, creating a cycle of earning and reinvesting that can result in exponential growth. This is what we call the power of compounding. Think of it as a race. The earlier you start, the more time you have to build up speed and momentum. The same principle applies to investing. The earlier you start, the more time your money has to compound and grow. So the earlier you start investing, the more your money can grow. But how do you begin? Stay tuned as we delve into understanding your financial situation in the next scene. Before you start investing, you need to understand your financial situation. It's like mapping out a journey. You can't plan your route if you don't know your starting point. First, take a look at your income. That's your fuel for this journey. Next, consider your expenses. These are the tolls you'll need to pay along the way. Having a clear picture of your income and expenses will help you determine how much you can realistically set aside for investing. Remember, investing isn't about making a quick buck, it's about growing your wealth over time. Now let's talk about savings. Before you start investing, it's crucial to have an emergency fund. This is a safety net that can cover your expenses for at least 3 to 6 months. Having this buffer will give you the peace of mind to invest without worrying about immediate financial needs. Once you have a clear understanding of your financial situation, you can start thinking about your investment goals. Setting clear and specific investment goals is a crucial step in your investing journey. You see, having a destination in mind before embarking on a journey is essential, and the same applies to your financial journey. It's not enough to simply say, "I want to be rich." Your goals must be tangible, specific, and most importantly, tailored to you. Investment goals can come in all shapes and sizes. For some, it might be buying a dream house. For others, it might be securing a comfortable retirement, or perhaps it's about growing wealth over time. However, the common thread that ties all these goals together is the desire to achieve financial security and independence. Remember, the more specific your goals, the easier it will be to formulate a plan and measure your progress. For instance, instead of saying, "I want to save for retirement," try, "I want to save $2 million by the time I'm 60. With clear investment goals, the next step is to understand different investment options. There are various investment options available, and understanding them is key to making informed decisions. Let's dive into the world of stocks first. These are essentially shares in the ownership of a company and represent a claim on part of the company's assets and earnings. Stocks can be a volatile investment option with prices that can rise or fall dramatically. However, they also have the potential for high returns, especially over the long term. Moving on, we have bonds. Bonds are like loans you make to the government or a company. In return, they agree to give you back your money at a future date, along with interest. Bonds are generally considered safer than stocks. They provide steady income, but the returns are usually lower. Now let's touch on mutual funds. A mutual fund is a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, and other assets. The benefit of mutual funds is that they allow you to diversify your investments and reduce risk, but they often come with management fees. Then there are exchange-traded funds, or ETFs. These are similar to mutual funds but are traded on stock exchanges. ETFs offer the diversification benefits of mutual funds while being more flexible and generally having lower fees. Lastly, let's not forget about real estate investments. This could mean buying a property to rent out or investing in a real estate investment trust. Real estate can provide a steady cash flow and potential tax benefits, but it also requires more hands-on management. Remember, each of these investment options carries its own unique set of risks and potential rewards. It's crucial to research each option thoroughly and consider your financial goals and risk tolerance before making a decision. Once you understand the different investment options, you can start building your investment portfolio. Building a diversified investment portfolio can help manage risk and increase potential returns. Now, let's break that down. Diversification in the world of investing is akin to the old saying, "Don't put all your eggs in one basket." It's about spreading your investments across various asset classes like stocks, bonds, or real estate to manage risk and potential losses. If one investment performs poorly, others may do well, balancing out your portfolio. Think of it this way. Imagine you're on a teeter-totter. On one end is risk, and on the other end is return. Your job is to find the perfect balance between the two. That's where diversification comes in. It's a strategy to help you balance that teeter-totter. So, how do we go about building a diversified portfolio? First, you need to understand your risk tolerance. Are you a risk taker willing to ride the market highs and lows for potentially higher returns? Or are you more conservative, preferring stability over potential high gains? Knowing your risk tolerance will guide your investment choices. Next, consider your investment goals. Are you investing for a down payment on a house in the next 5 years? Or are you saving for retirement 3 decades away? Short-term goals usually call for more conservative investments, while long-term goals can handle more risk. Once you've determined your risk tolerance and investment goals, you can start building your portfolio. A balanced portfolio might include a mix of stocks for growth, bonds for income, and perhaps some real estate or commodities for diversification. It's all about finding the right mix for you. Of course, building a portfolio is an ongoing process. As your goals, lifestyle, and the market change, so should your portfolio. Regularly review and adjust your investments to ensure they're still in line with your goals and risk tolerance. And there you have it, a simple guide to start investing in your early 20s. Remember, the earlier you start, the more time you give your investments to grow. Remember to stay patient, stay focused, and let your money work for you.